Good day all. Ira Epstein of Linn Associates with your agriculture wrap-up. And this is for Wednesday, the 4th of December, 2019, just getting on to 4:15 p.m. Central Time. Interesting day. I've been watching the hearings that are going on in the Judiciary Committee. Then, of course, if you see the stock market and how the markets were reacting today, you get a flip-flop of what the president said yesterday. Yesterday, Wilbur Ross, the president, giving us the idea no Chinese trade deal. 24 hours later, well, maybe we can get something done by December 15th. What did I say? And I'm going to stick with it. Trying to figure out what's going on behind the scenes. You're wasting your time. The charts are the only way that I look at it. And what I'm noticing is a pattern. We get a day off. You come in, you get a lot of volatility, and then that seems to drop back the day after that volatility. Just a point that I'm making there. We are getting a bit of a rally in the soybean market, corn down. One of the things to keep in the back of your mind is what I said, I think, this morning about farmers. The odds are that the farmers that have not sold any grain aren't going to really put a lot onto the market right now for tax reasons. Why not wait till January and then you don't have to worry about taxes until a year from April, if you think about how that all works. So that's what I think's going on. And our firms grain people are saying that's probably giving yourself a bid into the bean complex. I can accept that. That makes sense. Why the corn is down, I'll leave that to others. In the energy complex, always be careful when you have an OPEC meeting. Unlike when we have a Federal Reserve meeting and you get a statement afterwards, OPEC ministers meet, they send their first delegations days before the meeting, and then the rumors, what I call them are leaks, keep coming out. And that's what you've got going on right now. As for the nat gas, the market is still concerned that even with the cold spell that's coming, starting into the Midwest, probably around Saturday, Sunday, and it's going to be a good cold spell, that the build they're looking for tomorrow in the nat gas will overwhelm that for the moment, and then we'll see what the next weather front does. As we come into the soybean market, you're up right now for the week, 1.25 pennies. The market is still underneath the 891.5 zone, which means to me the bias is down on the longer term. When I take a look at the daily chart, you can see that the market's trying to give you a bounce area here. Now, will it succeed and how far it goes are the two questions. We're going to get a clue about that in a minute. I'll show you what it is. In terms of the swing line, and this is a chart without the swing line, this is the swing line. What the swing line does, especially if you've taken my charting course and you understand the concept, you're looking for patterns and then you're trying to develop within it a trend to define risk. That's all that it's about. Example, on the swing line, you've got lower highs that I've marked with the red arrows and certainly lower lows. Trend is down. What's the risk associated with the trend? Well, to break the current pattern, you'd have to get over 917. That's very far away. It's 30 cents away, roughly. Not saying it can't be done, but that gives you an idea of what you're looking at. And you decide from there, gee, do I want to risk that much going into a trend reversal? The next thing I do is I put on filters called moving averages, because no indicator on its own, other than I think the slow stochastic when it embeds, which needs to come out of that embedded reading, stands on its own. Therefore, the swing line I use in conjunction with moving averages. And as you can see, you've got the red, which is the 18-day average under the green, which is the 100, and the green is under the 200. They're lined up in a bearish formation. The market's made a plunge low off of that. Where might the resistance be on the upside and support on the downside? One of the support areas was running the Bollinger Band. Now, this is not typical that you run this far down. This was the washout in the marketplace, and now the question that traders will start asking, are we due for the seasonal lows? Is this where, with the lack of farmers selling, the market can get a bounce? We have no idea what's going to happen with U.S.-Chinese trade. That's another question mark. But the market's finally bouncing away, and it hasn't done that in a while, from that lower band. In fact, if you think about it, you were hitting that lower band every day starting back here, and finally you've gotten away from hitting it. That does not mean it's a bottom. It means it might have sold itself out there, but we don't know where the low is. We'll know that after the fact. As I said, I watch the slow stochastic in a major fashion. If and when the red line closes back over 20, the odds would then favor price making a run at the closest moving average. That, in this case, is the 100-day. Therefore, 899 would be the resistance point, not 917 number. So you get a lower area there. But until you've lost that embedded reading, the pros are likely continuing to sell short. Where? Well, I discussed that in my morning video because we use another set of moving averages to discover that sell or buy zone, and I won't spill all the beans here. In the meal market, if you take a look, you've got a pattern of lower highs, lower lows, and just like the soybean market, you're finally getting away from the lower Bollinger Band. In addition, the question is, can you lose the embedded reading? You haven't lost it yet in beans or meal. Therefore, until it's lost, it's not. My guess is the pros are stepping and going to look at this market. It's selling it somewhere between here and the 301 area, as long as the embedded reading isn't lost when the market reopens tonight. They'll be looking at those zones. There's a set of averages, again, that I use in the morning, and I talk about it there. Soy oil, still an embedded reading. So in the soy complex, we have those embedded readings, and my focus is now on them. Until they're lost, I'm looking for selling to continue in the market. When lost, just like in the stock market, we had a bullish embedded reading, it finally lost it, then you get your correction setting in. Sometimes you get the momentum, often of the slow stochastic being ahead of price, because the idea is that momentum leads price, not price leads momentum. That's at least what I teach. In looking at the corn market, you can see the battleground. It's the 18-day average of closes. We've hit it, 3-4 days now in a row. You can't seem to get going either side of it. And as that's happening, volatility's come out of the market. The Bollinger Band also looks at volatility, and that's these black bands. Markets stay within the black bands 95% of the time. When the bands narrow in, as they're doing here, it means volatility is coming out of the market, and like a spring in a pipe, the market is now winding itself up, and we'll see what goes on. From this point, whether you hit the top Bollinger Band, that's where I think pros would, if they were long, come out. If you hit the bottom, the pros, I think if they're short, will come out. And because there's no trend, there's no way for me to tell you which way I think they're positioned. You have the lower low, higher high, sideways action. In the wheat market, you stepped out of the uptrend. Your uptrend was in good shape right here. You'd hit the upper Bollinger Band. Remember what I said, 95% within it. It pulled back, hit it, pull back. Even if you got over, you started pulling back. And now this current break that you just had has taken out, if you look here, yesterday you took out 525 3/4. You no longer were trending. Now you have a higher high, lower low. In today's action, you made an attempt at the 18-day average, couldn't quite get there, came back up. But if you look at the slow stochastics, the numbers have now gotten away from being overbought. What's my definition of overbought? If either of the numbers are over 70, it's overbought. Under 30, oversold. Then we deal with the embedded situation, which is a little different. Sugar's a good example of a market that's overbought. Here's a market that's got readings in the 70s. Now, if we go to yesterday, the reading, one of the numbers was in 70 as well, not the day before. Oh, it was the day before. I didn't realize that. And you can see, this was a reading that was 80s, then began a correction phase, never got back under the 70s. That's important. So you're up at the upper Bollinger Band, overbought. The trend is higher lows, higher highs. Even though the market's over the band, and this is the first time you're over the 13-cent area in a long time. I mean, I can carry you back here into summertime. So that's an important sign. Can the market push out this band? I don't see the sideways action like we had in the corn that we were just talking about. Doesn't mean it can't happen. Is there a reason to be short? No. Bias up, trend up, overbought. That's about it. Coffee market. Still have the bullish embedded reading, which means both numbers that make up the slow stochastic are traveling sideways over the 80 level. Now, if you lose that reading with the red under the 80, the odds favor price will try to make a run at the 18-day average of closes. That hasn't happened yet. So like I said in the beans, until the market loses it on the pullbacks, I wouldn't be surprised that you're getting professionals trying to buy the market. In the cocoa market, even though the trend turned down today with the combination of now lower highs and lower lows, you didn't have that as of yesterday. You get it as of today because of the action. You're already oversold. So I'm not saying price can't drop. I'm saying that you've already used a lot of the momentum. That's what overbought, oversold is. Should the market decide to come down, the lower Bollinger Band to the 100-day average is the support zone. The major supports, the Bollinger Band. What about if the market flips back up? Well, if the market flips up over 25.76 and doesn't first take out 25.29, you could easily end up with higher lows, higher highs, reversing this downtrend, and the battleground would be 26.03. The point is the oversold condition filters out some ideas there. In the cotton market, you're also oversold. You have a 29 reading right now. That's under the 30 level. The trend has been down. You made a run yesterday for the lower Bollinger Band, could not follow through. It makes a little sense because the market's questioning, is there going to be a U.S.-Chinese trade deal? Cotton would be susceptible to that. It's still t-shirt business and all the other things that we use cotton in. So something to think there. What do I think here? Well, if you rally, the resistance is the 65.50 level, but you're oversold. So you've got to question how much the market would be up in the stochastics. But I'm looking to see the pros, what they do, and I would expect them to be in that 65.50 zone, trying to be bearish. Cattle today went into a collapse stage, but at the same time, it hit its target. If you think about it, I have been saying that I'm pretty sure I have sideways action, narrowing Bollinger Bands. Stochastics, trying to figure out which way to go. At this point, and this was last November 25th, a week ago Monday, you had a higher high, lower low scenario. First challenge of a Bollinger Band on the upside or downside is often where the pros step out of some positions. That's what I teach and that's what I believed. Can I prove it's every time? No. What I can tell you is when you get a narrow band, you're winding up. So the question is it going to run from here or is it going to pull back? You're overbought. Are you going to have any power to move? The market pulls back to that natural line, that what I call that line in the sand, the 18-day average of closes. This was this past Monday. Then the market gets a small bounce yesterday. Now, if you take out 12500 and don't come back up, you could have lower highs, lower low. The key is the 12500 zone. If it's taken out, what could be the next support? Remember, you'd be under the 18-day average, so that can't be it. It could be the lower Bollinger Band. Today, the market comes here with an outside day down, makes its run against that number. That doesn't mean you're not going to hit that number. Today's low missed it by about 14, 15 points. Momentum down, bias down, until today's high is taken out, be it on Thursday or Friday. This holds up. Now, if you take that out, then you get what we call a bear trap. An outside day is always a trigger for several things. I think it's got a 48-hour importance or 2 trading sessions. And as long as it's not taken out, I put it as the swing line top. If it were taken out, my target would be the upper Bollinger Band. You caught this group of people. Don't take it out. Now the question is with the bears, can they get to the Bollinger Band or under it? That's how I read the chart. Feeder cattle in a downtrend with today's action. Lower highs, you've had the lower lows. So until you get back up and over yesterday's high of 143.27.5, you have potential on the downside if it wants to follow through of 139.40. Take out this 143.27 and you negate the downtrend. Momentum, flat in the market. Last, in the hog market. The hog market, the last high of importance we had, if you take a look at this market, you had an outside day up. You take out that day's low and you're suddenly rallying back up. In fact, you get back over the 68.90 level. Now what do you have? I don't know. What I see is you lost the embedded reading. Do you see this right here? When that is lost, remember what I told you, the hierarchy of charts. It says that price and the 18-day average are likely to make a run at each other. That number was lost it was lost today, Wednesday. This is Tuesday's action. This is today. To finish it off, I think that the 18-day average and price are going to try to make a run at each other. Take out this low of 65.40, I got to go back to the drawing table. But on pullbacks right now, until that 18-day average is hit, I think the bulls are trying to grab minor control for a contra-trend trade. You know, I talked yesterday, and we've had a lot of sales on this today, about our Cyber Week sale. Now, let me explain what this is. I know a lot of you have tried our different research over the years. Some of you bought the courses that I teach, the trading course, and what I've decided to do this year is include in a special pricing for Cyber Week. The course is free. It's $179.95 value. I teach these 5 steps that I believe in, and I detail them. There's 54 video chapters that make up the course. Then there's a lot of written material, but really the meat of it's the videos. So you get the videos, you get charting software that works with it, and then special pricing on my research. And I have 3 levels of research. The morning video by itself, you can get the commentary only, or you can get the combination of everything I do as one of those trials to it. So you get all of that within the course, and that is, to me, the key. You can get as low as $156 for the yearly video. The course alone is $179.95. So if you think about it, you're ahead on that. Then you've got, if you take the full research or the commentary only, it's all there. How do you find out about it? Go to our website. Under the word research, you'll see Ira's research projects. You can see how they are. This only goes free, the charting course, with the 1-year subscription. So you can decide if you want to do that. Again, this week is going to run out quicker than you think. Hope you take advantage. I'm Ira Epstein. If you have questions, call my staff. They'll be happy to work with you. Have a good trading day.